Hi, today's my concept is the factors determining capital structure. In the previous class, I have explained about the capital structure and the significance of capital structure. Today I am going to explain about the some factors which will influence at the time of constructing the capital structure or at the time of designing a capital structure. The capital structure mainly include the main two component are debt and equity, and the other components of the capital structure or the components of debt and equity is dependent on the business. So for some industries or for some business, it is easy to construct the capital structure, whereas for some business unit they find it difficult to construct the capital structure. So it varies from industry to industry or business to business. One of the factor is the size of business. All the companies or all the business should construct the capital on the basis of their size of capital or size of business means on the basis of their business, whether it's a small business or small scale industries or medium scale industries or MNCs. On the basis of the size of the business they have to construct the business for they have to construct the capital. For small businesses it is very difficult to construct a sound or optimum capital structure because generally they raise the fund for a shorter duration. They may get the fund for long term or they may get the long term loan facilities, but there may be some unreasonable conditions which carries high rate of interest and which they find it very difficult to repay. So therefore, due to some restrictive conditions, their capital structure may be inflexible. Like for small businesses, whenever they raise the long-term fund or whenever they raise the fund through long-term sources, then they find it very difficult to construct optimum capital structure. So they have to construct the sound when they can construct the optimum capital structure whenever they raise less fund through the different sources. So generally the small businesses, they dependent on or their capital structure includes the share capital and retained earnings. The debt generally will not be the part of capital structure of the small companies. Why? Because they find it, if they can raise the debt, they can raise the fund through borrowing of money, but they find it very difficult to repay it because it carries high rate of interest. So therefore the small businesses, they have only the share capital, means equity and retained earnings in their capital structure. Means capital structure includes only equity and retained earning. Retained earnings means the part of the earning, part of profit or the part of earning which not declared as a dividend, which are retained for the future expansion or for the future growth or for the future project. So that is called as a retained earning. So that is the one factor for size of business to be considered at the time of constructing a capital structure. The next factor is form of business organization. Form of business organization means types of business organization. So again, while constructing the capital structure, they have to consider the form of business organization, means whether it is a private company or the sole trader or the partnership form, is it public company. So that has to be taken into consideration, because for private companies or for sole trader and for the partnership form, they have only limited ownership, is limited to only few hands, so their control is much significant or more important. Whereas in public companies it is not a problem because ownership is widely spread, so therefore control cannot be restricted. Whereas in case of private companies and partnership firm, or in case of sole trader, because of limited ownership, the control is much significant, more important, but not in case of public company. So that has to be considered at the time of constructing a capital structure. And another factor is the stability of earnings. The sale and stability of income affects the quantum of leverage. So the sale and stability of income, the consistency in case of income or in case of earning, that will affects on the quantum of leverage. the company which have high stability, or which have the stability in case of income and sale, they can use, they can borrow the fund through the debt, means they can use an amount of debt in their capital structure. So when the debt can be used in the capital structure, whenever the company have the good earnings, or the consistency in case of earnings as well as in case of sale, then they can use the debt in their capital structure, means they can easily pay their fixed financial charges, because once if the fund is raised through the issue of debt instruments, then they have to pay the interest, that is also high rate of interest. So when they can pay the high rate of interest, whenever there is a good income or stability in case of income and sale, then definitely they can pay the high rate of interest to the debt security holder. So therefore they can, in case of the companies which have have the stability, they can easily pay the fixed financial charges like interest on debt instruments. The industries which produce in the consumer goods face more fluctuations in their sales, so therefore they use the lesser amount of debt. The industries which dependent on the consumer goods, or which are manufacturing the consumer goods, they generally face more fluctuations, because it dependent on the seasonal products. So therefore in such type of industry, or in such type of business, they use a less amount of debt. The debt will be there in the part of capital structure, but it will be in the lesser part or lesser amount. So that is in case of stability of earnings. Next factor is the degree of competition. If in an industry the degree of competition is high, then such companies in that industry should use the greater degree of share capital as compared to the debt. The company which have this cutthroat competition or high degree of competition in their sector, then they have to use high degree of means higher portion of capital structure must be in the form of share capital, means equity, and lesser part in case of debt. Otherwise, in case the industries which the degree of competition is not so high, they have to tendency have the stable income, means whenever the competition is high, then the income will not be stable, there will not be consistency in case of earnings. Where there is a less competition, that the income will be generally consistent, or in case of uptrend, so there they can use the debt as a some higher threat, or they can borrow more debt, because they are in a position to repay the fixed financial charges. So that is called as a degree of competition. So whenever there is a high degree of competition, then the company is better to avoid, or better to maintain lower debt, or they have to maintain high equity in case in their capital structure. Whereas in opposite direction, if they have the lower degree of competition, then they can maintain high degree of debt, because they are in a position to repay that particular fixed charges. So that's about in case of degree of competition. The next factor to be considered is the stage of life cycle. Again, the capital structures to be created or to be built up based on the life cycle of a company. Each company has its own life cycle, and they are in the different stages. So they have to construct the capital based on their life cycle. If they are in the initial stage, better to avoid the debt. They must be dependent on the capital, share capital, equity. It is the best one, because they are in the initial, if they are in the initial stage of the life cycle, the possibility of failure is a high, more chances of failure. And if they are in a growth stage, then they can use the combination of both equity and debt in their capital structure, because they can repay the fixed charges, and they can borrow easily, they can raise the loan from the different sources, and they are in a position to repay it, because they are getting some income, they are in the growth stage. So whenever the company reaches to the maturity stage, then there again it is better to avoid the debt, or in their capital structure. So because uncertainty is more for their product, or for their main, not for the company, for the product. When they have to introduce new product, alternative product, and they have to invest more on the their production or on the marketing activity. So there the risk is highest in case of maturity stage because of uncertainty. They are in the maturity stage, so there better to avoid the debt, or lesser part of debt should be there in the capital structure. So that is in case of a stage of life cycle. So that also influence on the construction of the capital structure. And next factor is a credit standing. The companies whose credit standing is a better, they generally, the viewpoint is that investors or creditors are, through the investors or through the creditors, they can easily raise the fund. Means whenever the company is in a better credit performance or better credit standing, then they can have the capital as well, means equity as well as debt in their capital structure. But whenever the company's credit worthiness is, whenever if it is not in good position, if it is in a poor position, then better to avoid the debt in their capital structure. So that is a credit standing or credit worthiness of the company will also influence on the capital structure. The next factor to be considered is a corporation tax. So due to the current provisions of income tax, the use of debt in the capital structure is cheaper as compared to the ordinary share capital. So use of capital structure means debt as a in the capital structure is a cheaper one, less cost when compared to the cost of equity or the preference. Interest which are chargeable expense from the taxable income when compared to cost of equity, whereas dividend is paid out of earnings available after tax, so it is a costlier for the company. Hence the level of tax will also affect on the cost of capital. So therefore better to take the advantages of trading on equity. The management use of instead of taking the advantages of trading on equity, the management is better to opt for debt as a part of capital structure. Again, it is dependent on their taxability, not for all the companies, it dependent on their taxability. The next point is a state regulation. The capital structure of a company will also affected by the some government regulations. Of course they have to follow the, they have to adopt the government regulation. In India, Capital Issue Control Act determines the debt equity ratio for the companies. The minimum debt equity ratio, it will be decided as per the Capital Issues Control Act, and that has to be followed by all the companies. Similarly, the maximum rate of interest on debentures also fixed till 1992. So it means how much rate of interest to be paid to the debenture holders. There is also, for that also there is a restriction. Of course, for issue of capital as well as issue of equity as well as for issue of debenture, there are a lot of restriction, lot of regulation that has to be followed by the companies. And the directions or the guidelines which are issued by the SEBI or by the stock exchanges or by the companies act, that all to be followed at the time of creating the capital structure or at the time of designing the capital structure. So that is called as a state regulations. The next factor which will influence on the building of capital structure is the state of capital market. You know, capital market consists of two, the primary market and a secondary market. If the company wants to raise the fund through the issue of equity, then they have to decide, they have to collect the data about their trend or their reply for their company from the investors. That is important. They have to go analyze or they have to study their position in the market, in the stock market. Then they have to take the decision of issue of equity. Otherwise they can go for the other source of they can raise the fund through issue of debt security. So they can raise the fund through issue of equity whenever there is a good trend for their company in the stock market. If there is no good trend for there, if there is no investor, if the investors are not ready to buy their company's shares, then it is better to avoid the issue of equity in the capital market. Means they can go for other source of, they can go for other source of funds, means they can raise the fund by issue for debt security. So that means the state of capital market mean the timing of the issue of securities in the capital market will also to be taken into consideration. So it is another factor. The state of capital market means present trend for their company in the stock market, the present value for their security in the stock market to be taken into consideration before issue of any equity, because there is a need of investor in the market. If there was no investor, if the investors are not ready to buy, then it is a company will be in a high risk position. So they find it very difficult to build up the capital structure. So they have to study that particular attitude of the investors in the stock market. And another is a attitude of the management. So is another factor which will influence on the capital structure of the company. Because the attitude of the management is some managers are ready to take the risk, and if the management is ready to take the risk, then they can raise the fund by issue of debt, means they can add debt as a part of capital structure. The company or the management, when they can add the debt as a part of capital structure, that whenever they are ready to face the high risk. If they are not ready to face the high risk, then better to avoid the debt as a part of capital structure. So that is called attitude of management, will also influence on the capital structure. The next factor to be considered is trading on equity. So to arrange funds for acquiring companies' assets, the use of fixed cost sources like debt and preference share capital is called trading on equity or their financial leverage. If the return on assets acquired from the debt funds is greater than the cost of debt, the earnings per share will increase. So means they can construct a good capital structure. Whenever the return on assets acquired, if it is from debt, if it is more than the cost of debt, then it is earning per share will increase, means it is an optimum capital structure. The income will also increase by the use of preference share capital, but it will increase more by the use of debt funds, because interest is allowed as an expense from the taxable income. So you can increase the income through the issue of preference shares also, but it is better to increase or better to use the debt security to raise the income, or to raise the capital, or to create a fund, because there the expenses cost of issue generally less in case of debt securities. So that is in case of trading on equity. So that is also one of the factor which has to be considered under capital structure. Next factor is interest on coverage ratio. Interest, so by the use of this ratio, it can be ascertained whether the company has the capacity to pay interest or not. So why the interest coverage ratio is calculated? It is that will assess whether the company is in a position to pay the interest or not on debt security. The greater this ratio, more will be the capacity of the company to use the debt. If the interest coverage ratio is the highest, then it signifies the company is in a position to pay the interest on debt. So at that time, the company can add the debt as a part of capital structure. So the method or formula or equation for the calculation of interest coverage ratio is a earnings before interest and tax divided by interest. So there, whenever they get the high rate of interest coverage ratio, then it signifies that it is better to have debt as a part of capital structure. The next factor which has to be considered for the capital structure is the cash flow ability of the company. Sometimes the interest coverage ratio of the company is high, but it does not have the adequate cash to pay interest or preference dividend. So company's interest coverage ratio is high, means it signifies that the company is in a position to pay the interest to the debt, but that much cash, adequate cash, will not be there with the company. So that is, in such cases it is better to avoid debt as a part of capital. The amount of fixed charges will be greater if a company uses more debt financing or preference share capital amount of fixed charges generally will be high, even if the company is in a position to pay the interest, but they have to pay the higher fixed charges. So therefore they have better to avoid the use of debt. So that is again, it is dependent on the capacity of the company or the attitude of the company, or the, if they are in a position to take high risk, then they can add the debt as a part of capital structure. But cash flow ability of the company to be taken into consideration at the time of constructing or designing the capital structure, mainly at the time of adding debt as a part of capital structure, because they must be in a position to repay the interest. So generally it will be in a high rate, so there they must have that much of capital or that much of cash with the company. Next is another factor is the cost of capital. The cost of a source of finance is the minimum rate of return expected by its suppliers. Cost of source of finance is a minimum rate of return expected by its suppliers. The expected rate will dependent on the risk taken by the investors. Ordinary shareholders bear the maximum risk because no rate of dividend is fixed, whereas in case of and the dividend is paid after the payment of interest and preference dividend. So risk is more in case of ordinary shares or for the equity shareholders. The payment of interest on debenture is a statutory liability of the company, means they have to pay it whether the company earns profit or not. It's a mandatory, they have to compulsorily pay the interest to the debenture holders even if they are in a position of a loss. Therefore debt is cheaper as compared to ordinary share capital. Cost of debt becomes lesser because interest is a charge on taxable income. So in case of when you take construct the capital structure based on cost of capital, then is a debt is a cheaper one, because the cost which is required for the issue of debt is less when compared to the cost of equities, or when compared to the cost of ordinary share capital. Again, these all dependent on the financial strength of the company or dependent on the size of the company. So that is another factor which has to be considered at the time of designing capital structure. The next factor which has to be considered is the flotation cost. Flotation cost means the issue expenses, or you can say that expenses incurred at the time of issue of securities, either equity or the debt. If the flotation cost means issue expenses is less than the less in case of cost of debt when compared to the cost of equity. The issue expenses generally less at the time of issue of debt securities when compared to the equity. And it includes the flotation cost or flotation expenses, or the issue expenses include the like brokerage commissions or other expenses which are incurred at the time of issue of securities. So in case of debt securities, the flotation cost generally less compared to cost of equity. The company can raise the fund through the cost of raise the fund through issue of debentures or through the issue of debt securities. At the same time, it is not one of the main factor to be considered. So yes, about issue expenses is a less I mean in case of issue of debt security, so the company will not go for the debentures, but it dependent on the other factors. It is it is not the main factor of in case of designing the capital structure. It is one of the factor can be considered for the designing the capital structure. The next point is a control. In present times, the management wants to maintain its existence continuously and does not want any outside interference. So means same they want to have the good control on their management. Even ordinary shareholders have got legal right to appoint directors. If the company is paying interest and installment of loan in time, the creditors of the company cannot interfere in managerial decisions. So control is very important. So whenever there is a more number of debt, the percentage of the debt is high in case of a capital structure, then influence of the debt security holder generally is more on managerial decisions of the company. They will interfere more. So therefore better to avoid these sectors better to avoid the creditors as much as possible. Even if yes, it is a good source of raising the fund at a cheaper source of at a cheaper source they can raise the fund, at a less expenses they can raise the fund through the issue of debt securities. But there are a lot of other problems also, so risk is a more in case that sector. So better to avoid these reasons. These are the some problems which generally the company will face whenever they have the more part as debt in the capital structure. So generally the company won't adopt debt as a major part of capital. It is not good also. Therefore there is a ideal debt equity ratio is called as a 2:1. And if there is any changes in that particular if it is in opposite direction, then it is considered that the company is not in a good position. There are some problems in companies whenever the debt is more. So therefore the company must have the good control on the management to show that there is a means that good control will signify that lesser debt equity ratio. So that's all about the different factors which are to be considered at the time of designing the capital structure. The some factors are mandatory for all the companies dependent on their size, whereas some factors are dependent on their particular company. So that's all about today's class. Thank you very much.